Ladies and gentlemen, good day and welcome to Piramal Enterprises Limited Q2 and H1 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hitesh Tadda, Chief Investor Relations Officer from Piramal Enterprises Limited. Thank you, and over to you, sir.
Hi, good evening, everyone. Hope you are safe and in best of your health. I am pleased to welcome you all to this conference call to discuss Q2 and H1 FY22 results. Our results materials have been uploaded on our website, and you may like to download and refer during our discussion. The discussion today may include some forward-looking statements, and these must be viewed in conjunction with the risks that our businesses face. On the call today, we have with us our Chairman, Mr. Ajay Piramal, Ms. Nandini Piramal, Executive Director, Piramal Enterprises, and Chairperson, Piramal Pharma Limited, Mr. Khushru Jijina, Executive Director, Financial Services, Piramal Enterprises, Mr. Jairam Sridharan, Managing Director, Piramal Capital and Housing Finance, and Mr. Vivek Valsaraj, CFO of our company. With that, I would like to hand it over to our chairman and would request him to share his initial thoughts. Over to you,
sir. Good day and welcome to our meeting. During the last quarter, we have made significant progress on our strategic priorities, and it has been transformational for our company, marked by the achievement of two major milestones. First, we completed the DHFL acquisition on 30th of September, and this acquisition has created one of the largest HFCs in India that is focused on the affordable segment. The second thing we did was announce the pharma demerger and simplification of the corporate structure, which we did in October. The demerger will create two separate pure-play entities in the financial services and pharmaceuticals, in line with our commitment to the shareholders and investors. The DHFL acquisition is a major step in the transformation journey of our financial services business, which we have characterized in three phases. The first phase is consolidation. Prior to the DHFL acquisition, we had completed phase one, where we made the business more resilient by A, improving capital adequacy, B, reducing the loan book concentration, and C, building adequate provisions, and finally, diversifying the borrowing mix. The second phase is what we are going through now, which is a transition and quantum growth. We have achieved significant growth through the acquisition of DHFL that would have otherwise taken several years to accomplish through the organic route. Moreover, this growth has been achieved without infusing or raising any additional equity for the acquisition. The impact of the DHFL acquisition can be seen firstly in growth. Our total AUM has increased by 42% quarter on quarter to be 67,000 crores, and our retail loan book has increased by 4.3 times to 22,200 crores. We've now got diversification, and the share of our retail loan book has increased to 33% from 12%, which was at end of March. Besides that, we've got significant increase in scale and granularity and have created a platform with a pan-India presence with 301 branches across 24 states and union territories. We have an access to a customer pool of 1 million, and the average ticket size of the combined retail book is 16 lakh rupees, making the book more diversified and granular. The consideration that was paid for the acquisition as well, compared to the gross value of the book needs some explanation. The DHFL's loan book has witnessed a significant markdown by the administrator prior to the acquisition. Over the last 2 years, the book had already been marked down from 88,000 crores. Prior to the acquisition, the gross loan book, excluding the fraudulent assets, was 44,000 crores. We have paid a net consideration of 20,000 crores for the assets of DHFL. This valuation serves as an adequate buffer to mitigate any unforeseen asset quality risks. Since the DHFL's loan book is largely retail and has high granularity, it leads to overall de-risking of the portfolio. Also, there are no additional GNPAs or NNPAs as the loans acquired from DHFL have been fair valued. Consequently, the amalgamation of the DHFL book has made our overall asset quality metrics noticeably stronger. As a result, NPA ratios declined post the DHFL merger. GNPA for the combined entity has improved from 4.3% in June to 2.9% on September 30th. NNPA has reduced from 2.2% to 1.5%. Coming to provisioning, you would recollect that in the last quarter of the financial year 2020, at the onset of COVID-19 pandemic, we had created provisions of 1,900 crores incrementally. Despite conservative accounting of the DHFL loan book, improvement in the overall loan book mix, and a favorable real estate market scenario, we continue to maintain these provisions even after the DHFL merger. Provisions have been stable at 2,683 crores as of September 21. Total provisioning stood at 4% of the combined AUM, and provisioning against wholesale assets stands at 5.8%. The DHL portfolio has an average yield of 11% and has been acquired with 10-year borrowings at 6.75% per annum, and there has been no additional equity against this. Hence, we expect it to boost overall profitability going forward. Our phase 3 of our strategy is a sustainable growth and profitability. And this, with the DHFL acquisition now complete, we have put in place the appropriate levers for superior performance in the future. Borrowing costs have declined immediately after the acquisition, as the deal was partly funded by NCDs worth 19,550 crores at 6.75%. With a higher loan book diversification and growth, there could be further reduction in borrowing costs in the coming quarters. Post the DHFL merger, the leverage of the financial services business has increased from 1.6 as of June 21 to 2.7 as of September 21. With growth in the retail loan book, the leverage could increase to 3.5 in the near to medium term. We are also building a technology-led retail lending business, which should help us in improving cost efficiency as well as better manage asset quality. Moreover, the change in the product mix by launching new differentiated higher yielding products should also add to the profitability. Now I'll come to the second major strategic initiative which we have done, which is the demerger and simplification of the corporate structure. This was approved by our board in October. This was a long-awaited announcement by our stakeholders, as we have been taking several measures to simplify the company's organizational structure over the last 2 or 3 years. the pharma business will get vertically demerged from PEL and get consolidated under Piramal Pharma Limited. PPL will become one of the larger pharma companies listed on the NSE and BSE post the demerger. Our financial services, PHL Fininvest Limited, the NBFC, which was a 100% subsidiary of PEL, will get amalgamated into PEL to create a diversified NBFC, which will remain listed on NSE and BSE. Piramal Capital and Housing Finance, the HFC, post the DHFL acquisition, will remain a wholly owned subsidiary of PEL. We expect this demerger to be done between 9 to 12 months from the date of announcement, subject to all the various required approvals. Coming to the overall financial performance of PEL, we continue to deliver a resilient performance in this quarter and the first half, despite the COVID second wave and our conscious strategy to reduce the wholesale loan book. Adjusted net profit was stable at 1,090 crores for the first half. It's important to note that the P&L performance for the period does not include DHFL's financials. Organic retail lending disbursements grew 2.6 times Q-on-Q versus the same first quarter of FY22, showing a strong rebound from the impact of Wave 2. We launched 2 new product categories in this quarter, and our partnerships are also scaling up well. Collection efficiency in our retail portfolio recovered to 99% in September 21, similar to that of March 21 levels. In the wholesale lending, the performance of our developer clients significantly improved compared to the previous quarter, FY22, reflecting the trends in the overall real estate market. However, in line with our strategy to make the wholesale loan book more granular, we are consciously bringing down our wholesale book. In fact, no account exceeds 10% of the net worth of financial services. Our pharma business delivered a robust revenue growth during the first half of this year at 20%, delivering revenues of 2,983 crores. The pharma business contributed to 50% of PEL's overall revenue. The EBITDA margin was lower at 13% in this half. We expect a better performance in the second half, and which is expected to offset the lower margins in the first half. Historically, the second half has been better and is expected to be on similar lines this year. During the financial year FY21, H2 contributed to 55% of revenue and 65% of EBITDA. We did witness some execution-related challenges during the quarter related to logistics and availability of raw material and manpower. The CDMO business grew by 11%, and our development order book is up by 50% as compared to the same period last year. We are witnessing a robust demand of sterile fill finish in North America. In the complex hospital generics business, our first half revenue grew by 26%. The business witnessed recovery despite the impact of the Delta variant on demand for our key product lines in a few predominant geographies. We have delivered strong sales of sevoflurane in the US and continue to gain market share. There was a strong demand for injectable pain management products and maintained market share in the US intrathecal business. The India consumer healthcare business, the revenue in the first half grew by 54%, which was driven by strong performance in key brands. We have launched 6 new products in this first half and have a strong pipeline for the year. We are reinvesting our profit for future business growth. In closing, I would say that this has been a transformational quarter and for our company, and the steps taken by us have significantly strengthened the foundation to support future growth. Our balance sheet strength and uniqueness of our business model sets us apart, enabling us to create long-term value for our stakeholders. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The first question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, hi. So congratulations on all the business developments. Firstly, in terms of the breakup, if you can share this 20,000 crores between the retail and wholesale, and similarly in terms of from where the wholesale book was marked down to what level, and same with retail. So 88 to 44 and maybe 44 to 20, and breakup between retail and wholesale.
We have added, out of the 20,000, we've added about 18,500 crores for the wholesale, for the retail book, and the balance is for the wholesale book.
So wholesale is coming nearly at 1,500 odd crores.
About 2,000, yeah.
Yeah, about 2,000 odd crores. Okay. And the gross value of these assets would have been?
I think this is a sufficient enough detail, Kunal.
Okay, because that estimated value was around about 25,000 for wholesale and 27 retail. So is it like?
I think we have gone exactly on the basis of how we had bid for this thing. In the bids, this is what the bid we had done for both the wholesale and retail, and we have just followed that.
Okay. And in terms of cash, I think last time the sense was it should be around about 12,000 crores. Currently, it seems to be almost like 15.5, and net maybe of the liabilities, it seems to be like 14,000 crores. So is it more of a repayment which has happened, and we have got the cash since March, as that component seems to be higher than the expectations, and net consideration or asset acquired, that seems to be lower than the expectations. That's the only thing, yeah.
So it's a combination of both. There have been some repayments. There have been some, the repayments have been good and more robust than what we had thought, and there have been some prepayments as well.
Okay, sure. And if we look at this retail, so then 18.5.
All at one time now. I can't keep answering. You ask all questions at one time now.
Sure. So
between you and me, I'm sorry.
Yeah, sure. So firstly, in terms of when I look at the overall retail book and then X this 18,500 crores of DHFL, then the organic retail seems to be relatively lower, or there is not much of a growth out there. So definitely we have shared the disbursements number, but would want to understand the outlook on the organic side. And lastly, in terms of if you can give a more granular color in terms of how much would be the stage 2 and restructuring now on this expanded base. So was there any restructuring which was done in DHFL book, or maybe there was any restructuring which was done even in PEL book X of DHFL? Yeah.
Jairam, can you answer these questions?
Yeah. So, Kunal, firstly, if you look at the quarter that has just gone by, your observation is accurate that the disbursement growth is very strong in the organic retail book, but AUM growth is not. And the reason is very similar to what we saw in the previous quarter, which is that runoff of the old book continue to be quite high. Going forward, there is the way we are going to disclose is to show one consolidated number for the entire business, and you're no longer going to see separation between let's say legacy PCHFL book versus legacy DHFL part of the portfolio, etc. This is all one business now, and you're going to see the overall disbursement numbers and AUM growth numbers on the consolidated business going forward. Our expectation is that growth at the AUM level will start coming through in once we stabilize the book that we have just acquired through DHFL, and once all our policies and risk management infrastructure is put in place. So you should see that AUM growth coming through in in a little while. In the interim, we will continue to show you disbursement growth as a precursor to AUM growth. As you know, disbursement growth comes first in the retail business, and AUM growth comes a few quarters later. That's exactly what you're going to see here as well. So you will start seeing us talk a lot more about disbursement growth in initial quarters, and it will slowly translate into AUM growth in the times to come.
Sure. And color on restructuring?
Our restructuring, the overall restructuring in the book is just about 2%. Or so you'll know that our book is the retail that is a lot more self-employed than what you will see in the external market. So this is exactly what we are seeing in the market. We feel very good about the restructuring performance. New flows in this quarter have been relatively low, apart from the legacy DHFL book where there has been some, but otherwise this quarter there was fairly limited amounts.
Sure. Okay. Yeah. Thanks and all the best. Yeah.
Thank you. The next question is from the line of Nishant Shah from Point72 Asset Management. Please go ahead.
Hi, sir. Congratulations for the acquisition and also the corporate restructuring or the carve out of the pharma business. It's a good team structure now. I have a question on the Shriram part of the business. Is this still considered like a strategic investment? There's talk in the media about like some kind of reorganization over there. If given an option to exit, would you consider an exit from that, or do you continue to be happy to stay invested and like enjoy the growth in that business? Yeah, that's my only question.
We have said this before also. It's not a strategic investment for us, but at the same time, it's not that we are desperate to sell it at any time at any price. So at the appropriate time, we will exit. So in the long term, this will not be on our books, but at the moment, we will evaluate, but it's not strategic for us.
Fair enough. Yep, that answers it perfectly. Thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, congrats on the quarter. Just a couple of questions. They might be a bit repetitive, but so firstly, I'd just like to understand on Divan's book of 42,000 crores, what were the NPLs like that resulted in, you all valuing the book only 20,000 crores? And my second question is the loan book the home loan book specifically.
Engineer, your audio is breaking from your line, sir. Please check.
Oh. Operator, is this better?
Yes, sir. Please go ahead now. Thank you.
Yeah. So the home loan book would be about 15,000 crores, and how do you expect to meet the 50% for the HFC license by 2024? And then lastly, how do we think about net interest going forward from this 4.3% levels after accounting for Divan? That's all from my side.
So, Jairam, you want to take these questions?
Yeah. Happy to. So your first question was, if I recollect your three questions, your first one was on what was it, retail car?
So Jairam, basically what I'm saying is that Diwan's book was 42,000 crores.
Okay. See,
and we valued it at 20. What were the NPLs that resulted in?
I'll tell you. You're doing the NPA number. One important thing to keep in mind is the way the accounting has worked is through reflection of the fair value that was discovered in a bidding process. So this is unlike the situation where you have an existing book. You do a risk assessment of the book, and then you say, okay, I'm going to discount the book by X% because I believe X% of loss is going to come here, and that discounted value is what you see as the net book value. This is not that situation. This is a situation where a book exists. The book was transparently bid. In the bidding process, a final outcome came in terms of the discovered value of the full book. Now we are reflecting that discovered value in our balance sheet and then allocating the purchase price across the various asset categories, right? So trying to do a pure mathematical calculation to say what does this imply in terms of our expectation on NPA recovery or new NPA formation, etc., would be incorrect, because that's not the way this number has been arrived. This number has been arrived as a part of a price discovery process, right? Now, that price discovery has been appropriately allocated. That said, to your question of how much is the NPA book in Diwan, etc. The June numbers of Diwan are well known, so you can see it. It's in the public domain. The retail book of Diwan had NPA ratios of upwards of 25%. Of course, the way we have incorporated and amalgamated it into our book, the NPA ratio at which we have amalgamated it is basically 0%, because we have only amalgamated the good part of the book. So that's the way this has happened.
Okay, thanks. But then again, if the NPA ratio is 25%, the maximum hit you can have is 25%.
Not really. No. If the price discovery process results in, let us say, 10 cents on the dollar on a portfolio, 10 cents is what you can reflect on the book. Doesn't mean that 10 cents is what you expect to recover, but 10 cents was the discovered value of the book in my hypothetical example. In this case, 40 cents and change was the discovered value of the book, and that's what's reflected. And we will allocate that price across various asset classes.
Also to add, Piran, what Jairam mentioned, a large part of this book is secured book. Secured by assets which are house properties. And then what Jairam is trying to explain you is that, what you ended up paying for asset was 20,000 crore after the cash, if you deduct the cash that you got at DHFL balance sheet. So in all, you paid 20,000 crore for assets, and hence you are valuing the entire pool of assets as 20,000 crore. It has got nothing to do with asset quality of that asset pool. We wanted to remain conservative in terms of how we wanted to account for. We did not want to account for at value more than what we paid for, and hence we've accounted for 20, the price that we paid for assets.
Okay, so there could be upside potentially.
Yes.
Got it. Okay, thanks. And then the other questions, please.
Mr. Engineer, sorry to interrupt you. This is the operator. So your audio is breaking from your line. Please check.
Okay. Now?
Yeah, Param, we had another question on HFC percentage, and you made the valid observation that in the HFC our ratios are below the regulatory ask right now. However, the regulator has given a glide path on how to get there. We are going to be striving to achieve those, and we will be in constant conversation with the regulator in this regard.
But it's by FY24, regardless of anything, right? Even for y'all.
Yes, of course. That is the regulatory guideline. We will, of course, on a case-to-case basis, the regulator, I'm sure, will have conversations with individual players. So we will continue to engage with them on that point. Right now, there is no immediate sort of looming deadline in front of us. We will continue to strive towards increasing the retail ratio, as we have mentioned multiple times. So hopefully, or just organically, our strategy itself will push us in that direction. And we will be guided by what the regulator requests us to do.
Got it. And
This is the operator. Sorry to interrupt you, Mr. Engineer. We are not able to hear you. Request you to please rejoin the question queue. Thank you. We'll take the next question from the line of Alpesh Mehta from IIFL Securities. Please go ahead.
Yeah, hi. Thanks for taking my questions and congrats on the good set of numbers. All the questions are related to the accounting of DHFL. First is, I can see the goodwill increasing by almost 10 billion rupees. Is it on account of DHFL? That is first. Secondly, what is this transition cost of 1.43 billion for the DHFL merger? Third is, if I see the segmental reporting, the financial services total assets have increased by around 27,600 crores, around 27,600, whereas the loan book added is around 20,300, and our core balance sheet is largely flat quarter on quarter. So what explains this difference of around 73 billion rupees? The fourth question is, when DHFL reported FY21 earnings, at that point in time, there was a DTA outstanding of around 102 billion rupees, whereas in a consolidated numbers that we have reported, there is no increase in the DTA. So how the tax losses are going to be utilized, how the tax assets are going to be utilized after the merger. And the last question related to pharma, in the segmental reporting, pharma assets versus the debt reported, the pharma sector liabilities versus the debt reported in the footnote, the difference is around 23 billion rupees. What is that difference on account of? Thank you.
Okay, Alpesh, I'll take some of your questions. The first question that you had asked was with respect to increase in goodwill. So the increase in goodwill here is not DHFL. This is largely the Hemo acquisition. So we acquired Hemo. The total consideration paid and payable is about 1,000 crores. Currently, the purchase price allocation has not been done, and all of this has been parked into goodwill. After purchase price allocation is completed, this will get regrouped into the respective heads. The second question was with respect to the transaction cost for DHFL. This is largely the stamp duty that will be payable in the state of Maharashtra, as well as other costs payable to various consultants. That's what's accounted there. It also includes the transaction cost for the Hemo transaction, which had happened.
Tax. You take that.
Yeah, with respect to the deferred tax asset, again, this has been fair valued and marked down as we deemed appropriate in the purchase price allocation, and that's what's factored in terms of the increase.
Yeah, so sorry to interrupt you here. So will we be able to utilize this deferred tax assets in future?
So we are not valuing because we wanted to remain conservative, Alpesh, and we valued the assets only to the extent of what we are paying. Anything over the above will actually be upside, and we don't want to quantify upside in any form right now.
Yeah, but it is fair to say that there is a potential tax benefit component to this, which we have not quantified and put in here. But as you have seen, we have taken a book at a particular face value, and we have done fair value adjustments to a significantly lower value. And so the losses that get created because of that do give you eligibility for potential tax covers in the future. We are not quantifying that however right now.
Okay, and this will not, Jairam, this will not reduce the reported tax rate, right? It will be just the tax outgo that will come down. It is more of a cash flow accounting rather than the reported tax rate in future.
Correct.
Okay. The segmental reporting difference between the loan book and the gross asset increase because of DHFL, around almost 73 billion rupees.
Yeah, so it's primarily DHFL in terms of the increase that you see in the segment assets, and it also includes the other assets. So it has AUM and the other assets both put together. That's what you see the increase of about 27,000 crores.
Yeah, I agree. But that 70 billion rupees, large component of that, can I assume that it's more on account of cash and bank balance, or it's more to do with some other assets? Because obviously the fixed assets will not be that high.
It's got a combination of both cash as well as other assets.
Okay, great. And the pharma liabilities, segmental liabilities versus the reported debt?
Yeah, so if you're referring to the comparison of September 21 versus September 20, then earlier the debt related to pharma was shown under unallocated, and after the push down of the pharma business into Piramal Pharma, we've started reporting the number under the pharma segment. That's why you see a difference between September 20 versus September 21.
No, my question was related to if you come to the notes to accounts, capital employed segmental reporting.
Yes.
When you see the pharma sector liabilities, the total liabilities are around 57 billion, whereas in the same table below the notes to accounts, it's written around 33 or 34 billion related to the pharma sector. So the difference of almost 23 billion rupees in the pharma liabilities, what would that be on account of?
We'll get back to you offline on this.
Okay, great. And just a last question, sorry. Any recovery from all this wholesale book written off or the markdown value of the retail loans as well in future? There won't. So everything is the upside for us, right? There won't be any sharing of those with the creditors on this front.
Yes.
Yeah.
Okay, great. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, thanks for taking my question. Just 2 questions. The first one is a clarification wherein we had commented that the overall restructuring was 2% of the loans. Just wanted to clarify whether this 2% is in retail or as a proportion of the overall AUM.
Overall.
Sure, thanks. The next 2 questions that I have is to Jairam. So Jairam, in this quarter, I see that we have started this merchant BNPL and unsecured business loan in partnership with some of the fintechs. So if you could just dwell on both these products a little bit in terms of what are the commercials and what is it that we are exactly trying to do here. And the second question again is on disbursements. While we've been sharing disbursements that we've been doing under retail X of DSFL, on or maybe a conservative basis, what can we assume? What can the disbursement levels look like in retail loans with a DHFL under the fold in the subsequent quarters?
Sure. To your question first on let me start with the second question. It's pressure in my mind. The piece on disbursement trajectory. If you generally think about the size of network that has actually gotten added, and the fact that you can see that the overall network has increased by a fairly large number. However, a lot of the network increases from smaller locations, etc. So keeping that all in mind, once the engine starts really running from a disbursement trajectory standpoint, and people come to sort of target levels of branch productivity and people productivity, it wouldn't be surprising if you had the overall monthly disbursement rate go up 5 to 7x over the next 1 year or thereabouts. But it will be a gradual journey to go from here to there. But that kind of increase in monthly disbursements is certainly on the cards, and it is something that we would want to do. To your second question, or to your first question on product trajectory, where you spoke about the merchant BNPL and unsecured BL and some of these other products that we have started. We've been talking about this for a little while. We want to be a multi-product retail lending platform, and while we will be focused on affordable housing as our core pillar, there will be other products around it that we will create. And as an organization, we have appetite for around 20-ish% of unsecured lending in our portfolio. Now, it's not something that we are going to get to now or in the next 1 year or thereabouts, but over time, slowly, that's directionally where we will head to make sure that we have an adequate earnings buffer in the P&L as well. Now, in that direction, we are experimenting with a lot of different product categories apart from plain vanilla unsecured personal loans, which of course is something that we will do digitally. But apart from that, we have been trying consumer BNPL in the quarters past. This quarter we started merchant BNPL, which is essentially merchants on a platform connecting with their buyers. And on that platform we come and actually offer a BNPL, to the merchants. That's one thing that we are, that we are trying. And on the unsecured BL side, one of the things that you find in small town, mid-town India is that small merchants very often don't have collateral to actually offer. So to go ahead and do a lending relationship with them, you have to come up with an unsecured business loan, unsecured MSME lending product, which is what we have launched this quarter. It is purely focused on the MSME category, and needless to say, it is at a price point which is very different from what some of the other secured MSME lending like LAP, etc. would be. So this would be about 500 basis points higher priced than what a LAP might be, for example.
So thanks, Jairam. And if I can just squeeze in a follow-up question in the context of the response that you gave to the disbursements, that they could go up to 5 to 7x kind of disbursements from the current levels, monthly disbursement run rate. Would it be fair to say, given that our old retail book, ex-DHFL, kind of continues to run off at a swift pace, and the fact that the DHFL retail book, which you have brought on your balance sheet, again, I'm assuming it's a pristine book, which will always, obviously, again, continue to run off at a swift pace. Would it be fair to say that, AUM growth then would remain relatively muted, given that our stance that we will be looking to continue to run down the corporate book?
I think that is going to be true for the next quarter or two, but not beyond that. By that time, the disbursement trajectory will be sufficiently strong to offset potential runoffs. The other thing that is also needs to be kept in mind is that in the last year and a half, 2 years, in the erstwhile DHFL book, the portfolio retention activities have been relatively weak. We have designed fairly strong retention activities, and we would also undertake those and implement those in the coming months to make sure that the runoff is also reduced from where it is. But the overall mechanics of what you're saying is correct, that currently the repayments are higher than new disbursements, which means AUM growth is going to not be there. However, as the disbursements keep increasing and the prepayments keep decreasing, the lines will cross over the next few months, and once that happens, you will start seeing AUM growth again, which is of course the natural trajectory of all such transactions that happen.
And what's also important to see is the long-term targets that we are targeting of nearly 2/3 retail and 1/3 wholesale in 3 to 5 years. And you can see the kind of equity that the company has and the potential of growth that it can have. So, in a matter of few quarters, as Jairam is mentioning, the business is going to pick up the growth trajectory, at a decent run rate, and it will start delivering for its long-term targets.
And sorry, just one other thing to add. It's also important to keep in mind and not lose sight of the fact that what we have delivered in this quarter is a 40+% growth in AUM. So this is the sort of growth which it takes many quarters to deliver, and all that has come in one quarter because it was through this inorganic transaction, and that has completely changed the baseline for us as an entity without having to put in any incremental equity from our side. So we've there is a lot of this one-time big growth spurt that's going to hold us for a little while. However, on an incremental basis from this new baseline, you'll need to give us a few months for us to stabilize the book and get to a point where disbursements are higher than repayments.
Sure. I think this is very useful. I will come back in the question queue if time permits. All the best to you and your team.
Thank you.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So, firstly, on the CDMO business, now that the number of molecules in the phase 3 has ramped up from 10 to almost 34 over a period of last 3 to 4 years, any indication in terms of any of these molecules coming up for the commercialization and then provide a reasonable boost to the CDMO business? That is first. Second is, while the complex hospital generic sales has been pretty stable for last 2 to 3 quarters, But given that the COVID cases are on the rise over past 1 month, you see some impact on the business over the near to medium term. And thirdly, the Riverview facility expansion will take how much time frame? Thanks.
So on the CDMO business, firstly, as you rightly pointed out, there is increase in the number of phase 3 molecules, which obviously increases the probability of these going commercial. So, of course, there is a probability associated with it because it's in phase 3. But yes, that definitely will provide a boost to the CDMO business in terms of greater stability of revenues coming from the commercial. In terms of complex hospital generics, while in US we are seeing significant improvement and recovery, especially for our inhalation anesthesia portfolio, and that has helped maintain growth as far as our hospital generics business is concerned. In Europe and some of the other key markets, there are still some challenges. While we are hopeful that things would improve, but it's going to be a wait and watch situation. US is our largest business as far as inhalation anesthesia is concerned and for adjacent injectables, and that's where a large part of our business comes from. But yes, we would want to wait and see how it performs in the other markets. With respect to Riverview, the capex was a bit delayed because of the COVID scenario, and now it would be sometime mid FY23 when the facility would be ready post expansion.
Thank you. That's it from me.
Thank you. The next question is from the line of Sumit Chaudhary from Zada. Please go ahead.
Yes, hi, Mr. Piramal and team. Congrats on a good set of numbers. A question from me on the Divan side. So just from my understanding, the current quarter numbers don't reflect the P&L impact of the Divan transaction. So if you could just help us understand, what kind of yield should we expect to be delivered on the 20,000 odd crore book that you have taken over from Divan, and what kind of operating expense increase should we expect going forward because of this transaction? Thank you.
So if you look at the average yield of the book, mostly what we have consolidated is the retail book, so we'll just sort of it's easier to just focus on that. The average yield is a tad over 11%, and almost all of it is funded through 10-year NCDs issued at 6.75. So that should give you a little bit of a sense of what the spread is on this part of the business and what impact it should have on profitability. As far as OPEX is concerned, the OPEX levels, the current OPEX levels of the erstwhile DHFL business are extremely low, abnormally low, because of two things. One is that new business has not been happening, so cost of acquisition has been zero, and a lot of people have left, so it's a very understaffed team. So staffing costs are relatively low. So what you're likely to see in very initial stages, you might see OPEX ratios which are quite attractive for a retail business. However, you will see us making the right investments and making sure that we build a long-term franchise here. In the long run, you should expect to see at the overall organizational level, a cost income ratio for us between kind of wholesale retail, given the mix that we are targeting, at somewhere around the mid-20s is what you should expect to see, and that's the level at which we want to keep our disclosures. Over time, let's see, but right now we don't have an intention of specifically talking about individual business level cost to income ratios, etc. Let's see how this develops.
Understood. Thank you. And second would be on the pharma side. On the CDMO, I think you alluded to the fact that there were some logistics and manpower related issues which kind of delayed some of the delivery. So is that something that you expect to be resolved within this year, and should we therefore expect the overall business to grow on the pharma side at the run rates which have been indicated before, and the margins for the full year, should we expect them to go back to the, north of 20 to 25% sort of range for the year?
So the CDMO business historically, if you see, has always been lumpy. Roughly, we have about 45% of our business coming in the first half and 55% of the business coming in the second half of the year. But more specifically, if we were to look at the EBITDA, then you have 35% of the EBITDA coming in the first half and 65% coming in the second half. So this year, we expect it to be no different. It will be on similar lines. A little bit more pronounced in terms of EBITDA towards H2 because we've had a slightly adverse mix when it came to H1. So yes, we would see a growth coming back. We delivered 20% growth overall for the pharma in H1, and the overall pharma growth for H2 would be on similar lines. Though in terms of margin, we may see some modest decline because input prices have been going up, and obviously we are not insulated from that completely. Likewise, expenses on distribution and logistics have also been going up. So there may be some impact of that, a modest decline, but yes, more closer to what it was in FY21.
Okay, so overall, so the margins for first half have been closer to 13%. Full year, we should expect it to be closer to FY21, which is north of 20, if I recall correctly, around that level. So, okay. Okay, that's it for me. Thank you.
Thank you. The next question is from the line of Utsav Mehta from Edelweiss AMC. Please go ahead.
Hi, good evening. Thanks for taking my question. Just wanted to understand a little bit more granularity on the pharma business revenue. Is it possible to sort of share some insight into what percentage of revenue would be commercial, how much would be CRO, and how much would be manufacturing for clinical phase 1 to 3?
So overall, if you look at it, about 75% of our revenue comes from commercial, about 25% comes from development, and the 25 includes about 3% from what we call as discovery. Commercial, by the very fact that each consignment is a larger ticket size, is higher in value. So that's how typically the mix is.
And this 75% currently would be dominated by generic molecules, or is there a fair share of NCEs as well?
So it's a mix of both. We would put the mix at about 55% generics and 45% innovator.
Okay, understood. Is there, and last question on the margins, is there any element of pricing pressure or pricing erosion faced by clients on the generic commercial side, which is causing difficulty to pass through the raw material prices?
So as of now, right now, there has not been a very material pricing pressure on the kind of products that we have been dealing as far as our API generics is concerned. But on some of our injectables, we've been seeing significant pricing pressure, specifically in the US market.
Understood. And one last question, more strategic from my side. I saw in the long-term targets that entering the India domestic formulations market is a priority, and so something you all have maintained for a while. How does that sort of stack up with wanting to run a CDMO wherein they have complex or even innovative molecules? Would clients be comfortable with something like that, dealing with an organization that has footprints across both? Very rare, typically.
So I think our domestic formulations business is primarily India-based, as you are aware, and it primarily caters to the India market, whereas our contract manufacturing customers are those who are based outside and who sell products for the local markets in North America and Europe. As you're aware, almost 75% of our revenues comes from North America. So domestic formulations, what we do, if at all we enter the space again, would be very different market, different kind of products versus what we are doing in our CDMO space.
Okay, understood. Thank you so much for your time.
Thank you. The next question is from the line of Prakash from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. A quick one here on the pharma side. I heard you saying that, typically it's about 30-35% of the profit for the first half and the remaining in the second half, and there's a seasonality, which I totally understand. But when I compare the first half of last year and this year, there is a major difference. Could you explain that? First half of last year showing about 17% plus margin, and this year first half is about 12.5%. So what is really changing here from a like-to-like first half?
Yeah. So as I mentioned before, this time in the first half, we had a very adverse product mix, which means in our CDMO space, the contracts which were invoiced were comparatively lower margin compared to what we had last year. We expect this to get reasonably corrected towards H2. So it's an adverse product mix. Secondly, in line with our stated strategy, this year we have increased our sales promotion spend in our consumer products business to boost sales. As we've been saying, we'll reinvest profits to grow OTC business at a faster pace. So that spend has gone up. And in some of our overseas sites, due to various execution and operational issues, revenues had been lower, and we expect this also to catch up in the second half. As you're aware, overseas overheads are on the higher side, and therefore absorption of fixed assets has been lower in the first half. These we expect to get corrected in the second half.
So within CDMO, when you say the product mix has changed, when we see comparable like BVs and all the innovator businesses gone up and margins are actually gone up. So could you elaborate a little more on the product mix change in the CDMO space?
So I'm only talking of product mix change from a timing standpoint. So what got delivered during the first half were the comparatively lower margin contracts. The higher margin contracts would get invoiced and delivered in the second half of the year. That's what caused the mix issue. Otherwise, overall, our mix has largely remained similar to what it was last year.
Okay. And on the complex hospital business side, since US and other export markets is still seeing COVID cases, have you seen this business, seeing full traction, or it is still, would you see a faster growth going forward, or this is the growth one should expect?
So our inhalation anesthesia portfolio, which is a significant part of our complex hospital generics business, saw a good recovery post-COVID, especially in the US market now. In fact, sevoflurane has come back nearly to pre-COVID levels, with us having a market leader position in the US market. Some of the adjacent injectables, as I mentioned earlier, we were seeing some pricing pressure or lack of demand in some adjacent injectables. So in the US market, overall, the growth has been better and is coming back to pre-COVID levels. It's in the other markets in Europe where we've been seeing some challenges because of sporadic lockdowns or issues related to COVID.
Okay, and how's the pipeline looking for this complex hospital generic businesses? We had a couple of products which were expecting US approval. Are we on track to get it by end of fiscal 22, or how do we see that?
So, in terms of approval for the product that you are referring to, it has currently been delayed, and we don't expect that to come within this fiscal year. In terms of the other pipeline for other generic injectables, in the form of either in-licensing or sourcing from our own CMOs, we continue to work on that, and there is good traction in the pipeline. Obviously, the sales have got delayed because of COVID in some of the key markets, especially in the US market. Hopefully, this should start improving as overall position improves.
Okay. And lastly, just reconfirming, for full year margin on the pharma side, it would be at par or little better is what you said. Is that understanding right?
I said we would see a modest decline, and that's largely driven by rising input costs, raw materials, as well as logistic and distribution expenses. So it will see a slight decline versus previous year levels.
Okay. And next year we should probably get back to normalcy.
I would refrain from commenting for next year right away. We'll wait and see how things go.
Okay. Thank you so much.
Our endeavor is to expand margins, so we remain committed to our long-term strategy of expanding margins to the levels that we have stated earlier in our Pharma Day.
Okay, perfect. Great. Thank you and all the best.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment. Please go ahead.
Hi, sir. Thanks for the opportunity and congratulations on a lot of restructuring. Sir, reorganization rather. So on this financial side, what will be our directionally, if you can give some color of blended NIM with the change in mix of the business and post DHFL?
Hey, we're not offering forward-looking NIM guidance right now. Just, as you've seen, you can see the books NIM today in a pre-amalgamated form. The piece that is getting amalgamated, as I mentioned before, the gross yield is about just over 11%, and the cost of funds incrementally on that piece is about 675. So putting that together, that should give you a little bit of a view of what margins and spreads are going to look like in the coming 2 quarters. We are not offering any specific guidance at this point. In the next quarter, you will see the full quarter financial performance of the amalgamated entity, so it will be pretty straightforward from there on. And in the fourth quarter, we might consider offering guidance for next year. But right now, we don't have a guidance out on margins.
In the last question, we had acquired one land parcel against loan. So what is the status of that and monetization plan?
So that was a land parcel in Andheri East, as we had explained last time, and it's a large parcel. In fact, there has been progress on that, and I would not like to diverge much right now. There are some approvals which we are getting from the government, with some new approvals also coming. So in the next 6 months, probably we'll be able to share more in detail. But needless to say that we have progress in the matter, and we will share the details at the right time.
Okay, thank you very much, sir. All the best.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, thanks for allowing me a follow-up question. I'm referring to page number 34 of your presentation. Just trying to understand, after we include this 10-year NCDs that we raised at 6.75%, what is our stock cost of borrowings and what was our incremental cost of borrowings? The reason I ask this is, in one of the other slides you have mentioned that the yields of our retail portfolio, including DHFL, was about 11.2%. So now if we were to look at you as one of the largest HFCs in the country, with the current cost of borrowings, how do you see it trending down in the coming quarters, which would make you competitive to be doing housing finance, given that 75% of your retail book is indeed housing loans?
Yeah, so first, on your first part of your question, which is what is the stock cost of borrowing, that is the number that you actually see on page 34. Right, so the decline that you see, the 60 basis point decline in cost of borrowing from last quarter to this quarter is because of the addition of the on a pro forma basis. Obviously, you have not seen the impact of this in this quarter's P&L. You will see the impact in coming quarter P&L. But on a pro forma basis, if you were to just create a version of the stock, this is what it would look like. Now, on an incremental basis, the lending rates have clearly improved materially for us. We had come out with a retail NCD issue recently in which the cost of borrowings had a low 8 handle. So that gives you a sense of incrementally what has happened. Now, with the inclusion of DHFL and aggregation into our book, with the improvement in the NPA profile as well as the improvement in granularity of the portfolio, our hope and expectation is that incremental cost of borrowing will continue to improve from where it is, with or without any favorable action on the rating side. Either way, we should see improvement in the cost of borrowing, and that will continue to strengthen the overall NIM trajectory. Now, in terms of your question on competitiveness of the housing business, I want to reiterate that the housing business that we enter and that we are big in is the lower end, the smaller towns, these self-employed and cash salaried type of customers. Our average yield in the housing business even today is 11%. So this is not the 6.5%, 7.5%, 8% housing business that banks do. We are not in that business at all. We are targeting a completely different segment, which is fairly underserved by banks, etc. And that is the business model that you're going to see us pursue in the foreseeable future.
Sure, this is very useful. That's all I have. Thank you so much.
Thank you. The next question is from the line of Gautam from Deutsche Bank. Please go ahead. Gautam, your line is in talk.
Yes, sorry. Just wanted to just a couple of questions. I guess the first one was I think you already captured the fact that the DHFL acquisition book is captured at acquisition cost. Will there ever be a fair value fair valuation for that book done, or would it be maintained at acquisition cost? That's one. And the second question was when we talk about the margins on the DHFL book, how do we think about this? I mean, technically you have an 88,000 crore book that's been valued at just about 20,000 crore at PCHFL, whereas the debt, when you talk about the 6.75% borrowing, that's a one-on-one basis to that 20,000. But I guess the 11% yield that we get on the book will be on something that is going to be between 20,000 crore and 88,000 crore. So I guess just wanted to get a sense of how that would flow in subsequent quarters and years.
Both your points are valid ones. Like, see, on the first one, it is currently at acquisition, or it is a fair value. On surface it's a fair value process, but yes, it's heavily determined by purchase price consideration, and that's what you see here. A fair value process formally with the auditors, etc., is ongoing, and it will continue over the course of the next 6 months. We will finalize it, but I would be surprised if there will be any outcomes which are materially different from purchase price consideration. So you should assume that valuation processes are by and large closed, even though the audit process on that and creating the final fair value reporting reports, etc., will continue over the coming months along with the auditors. Now that leads us naturally to the second question that you have, which is that, hey, the interest that you are earning is on a book which is larger than 20,000. The interest cost that you are bearing is on roughly 19,000-20,000, and so the margins might be a little bit larger than what the spreads actually indicate. That point is absolutely valid. That is one of the underlying business cases of why you would do a transaction like this. And as to what the actual impact of that might be, you just have to wait and watch. Like when you see next quarter's numbers, you will get a little bit of a sense of what that expanded thing might look like. We don't want to speculate on that at this point.
Understood. And I guess lastly, just a quick follow-up on that. I think the credit ratings was kind of I guess put on review for both the acquisition and second the restructuring. Any sense on what the timing for the rating agencies to complete that might look like?
We will be having conversations with the rating agencies now that the results are over, etc. We will have our quarterly conversations with them, but this is not a thing that we control or we would want to push from our side. This is the sort of thing that the rating agencies will take their own call and in their own time. If they deem the level of progress in the company to have been adequate, they will take the calls that are appropriate. We don't want to unduly influence that process. But we are confident that we are doing all the right things. The balance sheet is moving in the right direction, and all the metrics that rating agencies typically tend to care for, all metrics are trending in the right direction. So hopefully we will see some favorable outcomes over the next few quarters. But it is their call to make, not ours.
Got it. Understood. Thank you for that. That's it from my end.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as the last question. I now hand the conference over to Mr. Hitesh Chadha for closing comments. Thank you, and over to you, sir.
Thanks everyone for coming on the call. If you have any more questions, please feel free to reach out to the IR team. Thank you.
Thank you. Ladies and gentlemen, on behalf of Piramal Enterprises Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.